Hello and welcome to Livewire's Views from the Top, our newest series dedicated to bringing you the best ideas and insights from those at the top of their game. I'm Ali Selby and today we're very lucky to be joined by Mike Lukin, who is the Managing Director of Roc Partners, for a deep dive into private markets. Thanks so much for joining us today, Mike.
Thanks, Ali. Great to be here.
For those that don't know you, can you just briefly tell us a little bit about Roc Partners and how you got started in private markets?
Yeah, no, absolutely. Look, we started 25 years ago. I came from a consulting background, and really the genesis of the business was helping some of the largest superannuation funds in this country attack private markets for the first time. So some of your kind of viewers may remember the dot-com era of the late 90s. So it was really then that kind of superannuation funds started to think about private equity, venture capital, and other alternative asset classes as a way to tap into that thematic of technology. And so I came across from a consulting firm to join Macquarie Bank. And at Macquarie, we basically built a business around helping institutional clients invest in private markets globally. In 2014, we did a management buyout and formed Roc Partners, and really with a view to expanding and growing what we're doing. And since then, we've built a number of other verticals into our business. So we invest in food and agriculture as a strategy. We have a private credit offering as another strategy. We have a growth equity offering, and then obviously a private equity kind of funds business that is the heritage of this business and has been in operation for over 25 years.
At the end of last year, we spoke to two high net worth financial advisors, some of the best financial advisors in the country rated by Barron's. Yeah. And they told us that private assets are going to play a major role in portfolios in 2024 and beyond. Why do you think financial advisors are allocating more and more to private market assets?
In the Australian context, some of it is catching up with the rest of the world. So private markets in that high net worth industry has been around for a lot longer. So we talk in the US to some of our clients who are foundations, endowments, high net worths, and they've been investing in private markets for a long time. The venture capital industry in the US really started from high net worth investors investing behind technology professionals who are looking to help support businesses. And it's really kind of only recently that we've seen that come to Australia, that focus on private markets. And there's a couple of reasons for it. I think firstly, the opportunity for higher returns at lower risk. So from a risk-adjusted perspective, private markets are pretty attractive. You know, you see parts of the market like private equity and venture capital kind of can generate outsized returns. Other parts of alternatives like infrastructure can give you stability and yield. And all up, they give you a lot of diversification away from listed markets. And I think increasingly what we're seeing is more opportunity in the private markets at the expense of public markets. So if you think about infrastructure, you think about healthcare, you think about high growth businesses, a lot of those aren't available anymore in the listed markets as they were 20 years ago. And I think for financial planners, the other aspect is actually quite valuable for them in terms of sourcing deals. You know, a lot of high net worth investors today can plug into ETFs, they can plug into a CommSec account and trade stocks every day of the week. They can't do that in private markets. Private markets are private. And so having access to that deal flow is really kind of quite an interesting aspect for a financial planner in continuing to build their relationship with their client.
Okay, Roc Partners specialises in private equity and private credit. I want to go back to basics now. Mm-hmm. Can you explain the key differences between those two different areas of the market?
Yeah, absolutely, Ali. To put it into context, people get really kind of frightened by private markets generally as a concept. It's like, oh, it's private, it's scary, who knows what's going to happen behind.
It's opaque.
Yeah, it's opaque, kind of what's happening behind the box, right? The reality is it's not dissimilar to investing in Commonwealth government bonds and the listed equity market. So, you know, private equity is simply equity in private companies. Listed equities is equity investing in public companies. Private debt, similarly, is like buying debt off the Commonwealth government, but rather than being off the Commonwealth government, it's actually off private businesses that are, you know, not listed on markets. And so, you know, kind of, if you kind of forget about the prefix, the private bit, and you focus just on equity, it's like, you know, the bank owns the mortgage in your house. That's the debt element, and you own the equity in the house. You know, we invest in both parts of that in private businesses, and that's really the kind of private equity model, the private debt model that we operate in.
Can we go in a little bit more granular detail now? Can you explain the subsectors in which you typically tend to invest?
Yeah, no, absolutely. So in private equity, we're really looking for industries that are, show lower volatility than other parts of the economy. And we're looking for industries that are growing faster than the GDP. And so if you think about the Australian economy, for example, areas we like are things like healthcare, ageing population, kind of we're all going to use more healthcare. There's more and more opportunity to use healthcare. There's more kind of services available. That industry as a whole is growing faster than the economy. It's also relatively stable. If the economy is good or bad, you still got to go get your hip replaced, or you've still got to go get your surgery undertaken. You don't have the same volatility that you see in, say, really consumer discretionary retail, or in mining services, or in construction services, where you tend to see real, changes in the kind of the environment in those kind of industries. So really focused on things like healthcare, like childcare, like business services. So growing faster than the economy, but less volatile than the economy. And that kind of focus kind of extends to our private credit business as well. Kind of when you're a debt investor or a credit investor, you want businesses that are stable, can generate cash flow. You aren't going to see them kind of boom and bust in the same way other sectors do. So again, very much a focus on stable sectors of the economy where we can really project out the cash flows and really kind of underwrite, this debt piece is going to be able to be repaid back in 3 years, 4 years, 5 years, depending on the maturity of that debt position we're taking.
What trends are you seeing in terms of liquidity? And does this mean that private companies are less likely to come to public markets for cash? I mean, think of Canva, for example.
Yeah, Canva's a great example,
Yeah.
right? So the Canva is a $26 billion US business. It would be listed in the top 50 in Australia every day of the week. It continues to grow outside of public markets. And you compare that to, say, 20, 25 years ago now, when Google first listed. Google listed at a market cap that was far smaller than what Canva is today. We all know the Google story since. And what's happened is the attraction of private markets has been a little bit of a snowball. So you've seen more and more money come into the space, more and more specialisation around different parts of the ecosystem. So in the venture capital universe, you've seen early stage investors that would have picked up Canva when it was doing basically Year 12 formal books, and growing that out till what it is today, competing with the likes of Adobe and Microsoft globally. And so there'll be a different investor at that start, in the middle, and the end. And then beyond that point, you may find that a listing makes sense. And really, I think, what's fascinating for an investor looking at private markets is because that ecosystem is now so built out, there's far less opportunity as a pure listed investor to get access to outsized returns, because the attraction of private markets is a lack of transparency. So think about it as the management team or the founder. My competitors, if I'm Canva, I'm not kind of telling Microsoft what I'm doing. I'm not putting my product roadmap out to the market. I'm not telling them my financial position. I can be quite stealthy around how I kind of build my business. And so that's really valuable. And I think, more and more what we're seeing as well is public company directors and boards are more focused on compliance, reputational risk, and the more regulatory side of how you operate a business. Whereas in the private markets, yes, we worry about all that stuff, obviously, but 90% of the board meeting is about strategy. It's about how do we grow? It's about how do we fill the gaps in our management team, and really focused on adding value to the business. And so as a founder, you sit there and say, well, there's my two options. I can tell the world what I'm doing. I can kind of have a regulatory oversight committee on my board, or I can find some investors that will be really valuable in terms of the networks, relationships, accessing, say, the US market for talent, and I keep everything private. And so increasingly more and more stuff's going to be done privately, and so you really will only list when it's kind of like the end of the journey. And I think so as a result of that, as an investor, you really got to think about, well, if I want to generate outsized returns, I'm going to have to delve into private markets to get access to that.
We've seen this really great disparity in returns in public markets, particularly over the last maybe 18 months.
Yeah.
Are the returns more predictable in private markets?
Yeah, look, I think the reality is in private markets is you're using a repeat skill set. And so I wouldn't say they're more predictable in terms of year to year, knowing next year private equity is going to deliver 30% or it's going to deliver 10%. What I think you have is, I always say, you always read these disclaimers when you're reading kind of, reports from listed equity managers, past performance, no guide of future performance. In private markets, that's not the case, because you come to a deal with a toolkit, and being able to use that toolkit on a regular basis is actually what creates value. So if you're good at helping businesses grow by having a great Rolodex of management, talent that you can bring into a business, or you've fundamentally got a great opportunity around how you do M&A, that's a repeatable skill set that adds value to businesses. And so I think the reality is, in private markets, if you find the right partner from a private equity fund investing perspective, you really can tap into that repeatable skill set that generates alpha over the long term.
Why do you think private markets remain so opaque today?
Yeah, it's a good question. I think the reality is they're becoming less opaque. So you're seeing things like the secondary market globally taking off. So this is where people trade in private equity positions on a unlisted basis. So it's a bit of a kind of a brokered market, but not like a stock exchange. So you see more kind of transparency around pricing for private market investments. You're seeing more open-ended liquid vehicles come to market. So there's a number of groups that are now offering open-ended vehicles to get access to private markets. They generally kind of tell you what's in the portfolio. But I think some of the benefit and some of the beauty is that lack of transparency. It means your competitors don't know what you're up to. It means that when you go to sell a business, no one's really got a kind of an anchor point. If you're a listed kind of player and your equity has kind of sold off 90%, it's really hard to get anyone to pay you a material premium. They'll kind of say, well, you're off 90%, we'll give you a 30% premium on that reduced value. Whereas in the private markets, there's no anchor. And so you have the ability to kind of say to the market, what do you think our business is worth? And people aren't anchored to a certain point. They may think this business is terrific and worth a lot more. So I think there's more transparency from an investor perspective, but the stuff that creates the magic around private equity is still as opaque as ever, but it's actually in investors' best interest for that to be opaque.
Is there any chance you could talk to an example of a recent opportunity you've identified where I guess we could talk to that opaqueness as being a benefit to you at Roc Partners?
Yeah, no, absolutely. So I've been traveling a little bit. I was in the US a couple of weeks ago, and we've been kind of following a certain private equity firm in the US, and they raised a fund, started raising a fund about 12 months ago. And as you probably know, and your kind of viewers know, it's been a pretty tough market in capital raising world, kind of more broadly. So their fund has been open for a lot longer than what it historically has been. So historically, some of these funds are open and closed in 3 months. In this case, it's been open for about 12 months. And they did a deal this time last year in a really high quality pharmaceutical business that they have transformed in the last 12 months. And so they were buying off a kind of earnings stream that was $300 million in earnings. They've now kind of done 3x on that earnings stream through cost initiatives, through procurement, through better supply chain, through some sale and leaseback activity, really grown the earnings of this business. Because we're in the private markets and the way things are traded and treated, we've been able to kind of go back in time and invest in their original entry price. And so we'll get the benefit on investing today on what they paid 12 months ago before they did all these initiatives to add value. And so we'll come into this deal, we will get the benefit of a 60% uplift on our money on day one, and really with an opportunity to deliver a 5-6 times money return on that opportunity over a very short period of time. So, even since kind of we've started talking to that private equity firm in the US, they've appointed bankers and they're looking for an IPO later this year, which will generate a massive return for our investors. So the fact that these opportunities aren't listed on a stock market where every equity analyst around the world is downloading the ASX 300 and going through every stock and saying, well, where's the opportunity? The fact that we're out hunting these opportunities, we're following, this is a private equity firm we've invested in for the last decade, we know them well, we trust that they are successful in terms of their strategy around businesses, we can take advantage of those opportunities that you wouldn't know about otherwise. And so that's a really kind of real-time opportunity we're looking to close out in the next couple of weeks.
Okay, I want to turn to private credit now, which has really taken the world by storm over the last 12 to 18 months. Now that many experts believe that rates are peaking or they've peaked,
Yeah.
can the good times continue for private credit?
There's probably a couple of elements to that. I think firstly, we're seeing a lot more money move into, call it the pension phase across superannuation. So when I started working in superannuation, most of the funds that we now talk about as the big six were sub $1 billion. You know, the industry was only kicking off. Everyone was putting in 3% into their super. Roll forward 25 years and we now have this whole cohort of people who have got to retirement age and are looking for an income stream to kind of supplement their lifestyle and have got big superannuation balances that they're kind of tapping into now for the first time. As a result of that, they're looking for higher yield than what they can get from their kind of bank, from a term deposit or from a cash account. So yes, private credit has taken off over the last couple of years, but I think this is a maturation of the funds management industry in Australia as we see people moving from accumulation to more of a pension and drawdown kind of point in their life. I also think that, you know, what actually kind of started the interest in private credit was not so much that rates were now at 4.35%, but it was actually when rates were at zero. And people were saying, I have money in the bank and I'm getting nothing on it and I'm eating into my capital base every day to go on holidays, to pay for cost of living, whatever it is. And so it was really then that, you know, what we saw was, you know, an emerging interest in private credit as a way to generate, you know, 4 or 5% when the bank was offering you nothing. What we've also benefited from, obviously, over the last 2 years is that 4 or 5%, it's become 8 or 9%. And I think longer term, you know, we won't see rates back at zero. We'll see rates kind of maybe in the 2 to 4% range over the long term, with the economic cycle determining where we are in that range, which means private credit will deliver a 7 to 9% style return longer term in the market. And why is that? It's not dissimilar to private equity. It's that illiquidity premium you get from investing in private credit. It's from the fact that historically a lot of these debt kind of provision was created by the banks, and so the banks would take a margin on that. The investor is now basically taking that margin themselves as opposed to getting access to it through the banking sector. I think the real interesting aspect as the market here matures is splitting out, I guess, the wheat from the chaff. You know, I think there is still a bit of naivety and maybe a little bit of lack of sophistication around that all private credit is not the same. You know, a lot of people get caught by the kind of headline numbers of I'm generating a 15% return on my private credit versus someone who might be delivering 7. The reality is you're kind of taking a lot of different risks and a lot more risk to generate 15%. It's more equity-like versus maybe down kind of the risk spectrum towards the 7% end. At the end of the day, when rates are zero and someone's borrowing money at 15%, there's a reason why that's the case. Their ability to repay, the risk around the business model, whatever it is. And so I think the next kind of, you know, chapter in the private credit story in Australia was people making decisions around where in the private credit spectrum do they want to play.
I want to turn to deal activity now. 2023 was obviously a slow year for M&A. Mm-hmm. Do you feel like that could turn around in 2024 and beyond?
I think we're starting to see the emergence of deal activity in the market, and it's kind of like the duck kind of paddling underwater at the moment, where a lot of the advisors are getting prepared for a lot more deal activity this year. What we're seeing is that buy-sell spread. You know, we've gone through a period where the buy-sell spread of what a vendor wants for their business versus what a buyer wants to pay for that business is really narrowing. I think as we get to the end of this kind of tightening cycle and more thought around when are interest rates kind of falling, I think, you know, the reality is in private markets, sellers generally look in the rear vision mirror, the valuations their, you know, peers got, you know, in the last 12 months, 24 months, whereas buyers look at the forward-looking indicators, what that economy looks like. And I think those two are kind of gravitating towards a central position. And when we get to that central position, we'll see a lot more deal activity. And I think, you know, whether it's corporate M&A, IPO, secondary sales between private equity firms, I think we'll see a lot more activity as we go into the back half of 2024.
Okay, Mike, last question for today. We like to ask all our guests the same question at the end of these interviews. It's what is something that you've learnt recently or that you've realised recently after all your decades in markets? What's your unique view from the top?
To me personally, I think alignment of interest is everything, right? And so I say follow the money. Like work out when you're investing, whether it's a fund investment or a private company or a public company, where's your money going? Is it allowing people to take money off the table and leave you stranded? Is it to help grow the business? Is the management team, is the founder aligned with you in terms of they own the same kind of instrument that you own? And make sure that you get that alignment right. I think that is kind of, fundamentally probably the biggest kind of lesson I give all my guys in the team, that if you don't know who's the sucker on the table, the sucker's probably you. So really kind of focusing on kind of following where money's going and kind of how you're aligned with your kind of eventual kind of the person who's going to make your return for you.
Okay, well thank you so much for your time today,
Pleasure,
Mike.
Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.